Another plot that is very useful, another very useful diagnostic plot is this one, which is a actual versus expected plot by predicted band. And to construct this plot, what's been done is that the holdout sample has been scored using the model. So you've predicted the probability that each record will renew, or each policy will renew, and then you've ordered them from the ones most likely to renew to those least likely to renew, and then they've been banded, so in 2% band. Oops. So up here we have the top 2% of renewers, and down here we have the worst 2% of renewers, and we've got both the predicted and the actuals shown in red. And if those two lines overlay each other, that's one indicator of goodness of fit. And the other reason this is quite good is it gives you an indication of how well your model does at separating those who are good renewers from those who are bad renewers. So here we see the best 2% of the sample have a renewal rate of about 99%, so they're very, very sticky. And the worst 2% have a renewal rate of around 65%. And if we do this plot on our TreeNet model, we get pretty much an identical thing. So both of them are performing, similarly when it comes to separating good renewers from bad renewers. Now, the reason for building the renewal models is to end up with, demand curves for individual policyholders. So here I've given a plot of the demand curves for two different policies. And what they show is how the renewal rate changes as we move from the current price. So that's a decrease and an increase. And you have basically different shapes of demand curves for the different policies. So if I overlay those demand curves, we see we've been able to identify those customers who are less sensitive to price increases. So having done that, we're now in a position to apply optimization techniques. So in the final part of today's talk, I'd like to give a brief example of setting the optimized prices. Now the setup I'm going to be talking about is a single year projection. So the idea is to look out how a particular pricing structure affects renewal rates, how much premium is collected, and how much profit is collected just over a 1 year period. Now in practice, you'd probably want to consider multi-year projections, where you look at the outcomes over many years into the future. You'd also like to consider the interactions with new business. Here I've only considered renewal, and the reason for doing that is just for simplicity for presentation today. In the examples I'll show you, we talk about a current price, and that's just been set on a cost-plus basis. So the current price is just the expected cost of the policy, the expected cost of expenses, and then a simple percentage target loading or profit loading has been added. And finally, we've introduced some individual constraints, and they're just simple constraints. Here it's just a plus or minus $50 constraint from current price. And again, the reason for doing this is just a safety net. If our demand model is not working that well for large price ranges, this is just a safety net so we don't do too much damage. So having set this up, we're obviously in a position to do optimization. But before I do that, I'd just like to run through a few scenarios. So the setup also allows you to test the outcome of different scenarios, the different price change scenarios. So in this example, what I've done is had a look at what happens to profit and what happens to renewal rate if we just say add $30 to all policies for people under 30 who live in the outer suburbs. And obviously you get a slight increase in profit when you do that, but it also comes at the expense of a decrease in renewal rate. Another scenario you could try would be to add $20 on every policy. If you do this, your profit goes up quite a bit, but it again comes at the expense of a much bigger decrease in renewal rate. Alternatively, you might add, instead of adding a constant dollar amount to each policy, you might add a percentage loading to each policy and see what happens. So here a 3% loading has been added. So in this case, larger policies get a larger absolute loading amount. And you can see that this has actually improved both profit and renewal rating compared to scenario 2. And this just shows that in more detail. It shows the impact on revenue accounts of that pricing scenario. And you can see the results of column 3 here and 2. And 3 is better than 2 in all instances. So we've got more gross written premium, more profit, and more policies in force. So I mentioned before that one of the main reasons in an optimization context for building the renewal model was to get demand curves for individual policies. And what that's done is allow us to identify customers who are less sensitive to price increases. So with this information, is it possible to improve our scenarios? So just to give some examples, I've run 2 more scenarios. One where we take those people who are least sensitive to price increases and increase their premium by $50. And another scenario where we've looked at those who are most sensitive to price and increased their premium by $50. And obviously you expect scenario 4 to give a better outcome than scenario 5. And that's what happens. When you add the $50 on the third with the flattest demand, you get quite a big increase in profit and with a relatively small decrease in renewal rate, compared to when you add it to the flattest, those with the steepest demand, those who are most price sensitive. You get not quite as much profit and a far lower renewal rate. So that was some examples of scenarios, but one of the main reason is to do the optimization, and the idea is to find out what pricing structure will give us the best result possible. And as I mentioned before, the best result, there's never any one best result possible. Things are always a trade-off, and in this case it's a trade-off between profit and the number who renew. So here I've done a point optimization, which is where I've tried to work out what the maximum profit we can get if the optimization is constrained to give a renewal rate of 90%, which is our current renewal rate. And we can see we can get about a 3.6 million increase in profit if we optimize our pricing structure. So if we redo that point optimization at many different renewal rates, so ones which span all the way across here, we end up with the efficient frontier, which gives us a range of best possible outcomes for different profit renewal rate trade-offs. And then it's just decision for management to decide which part on the efficient frontier would best meet their objectives. So for example, if they want to maximise profit but don't want to lose any business, the best they can hope to achieve would be about a 30% increase in profit. Or alternatively, if they were happy with profit levels but wanted to increase the size of the book, the best they could hope is a 1.5% increase. So that was, an overview of price optimization. It's a complicated areas, and I glossed over a lot of things, but the main things I wanted to point out was that some insurers are now building detailed analytical models of all the components involved in price setting, and they're using that to optimize their prices. And by doing that, you have an objective way of setting your prices to meet specific goals, such as maximising profit or increasing the number of policies that are sold. And of course, building good customer demand models is essential to the success of this approach. And finally, data mining software such as TreeNet greatly increases the speed of building quality demand models. So, thank you.